Hi Rabbits, Research Turtle here. We're looking at a post-mortem of the American green transition. As of January 2026, the era of modern supply-side economics is officially over, replaced by a regime of energy dominance. This isn't just a regulatory pivot, it is a fundamental redefinition of value, where carbon has shifted from an environmental liability to a geopolitical asset. Let's look at the situation report. The numbers tell a brutal story of reversal. Fossil output is surging, up 12% year-to-date, driven by a deregulation boost. Conversely, green investment is frozen. We are witnessing capital flight as the market reacts to the new administration's priorities. The green transition hasn't just been paused, it has been canceled. To understand how we got here, we have to look at the clash of economic theologies. The Biden era, led by Yellen and Deese, operated on the belief that government creates markets to solve long-term externalities like climate change. The Trump era, weaponized by Besant and Wright, operates on Trumponomics 2.0. Here, resources are assets to be leveraged for national power. The pivot is stark. Markets are no longer for solving climate problems, they are for maximizing national wealth and leverage. The political collapse of the Green State was caused by a fatal lag, the Valley of Death. Structural investments like the Inflation Reduction Act required years to bear fruit in terms of jobs. However, the inflation pain was immediate. This vulnerability allowed the opposition to frame green investment as wasteful spending before the factories could even open, creating the pivot point for the 2024 election. The mechanism for this dismantling is the One Big Beautiful Bill Act, or OBBBA. Passed in July 2025 via reconciliation, this machine functions as a fiscal offset. It systematically cannibalizes green subsidies to fund corporate tax cuts. It is a direct transfer of wealth from the green sector to the legacy industrial base. We see this dismantling across the entire policy matrix. The tech-neutral credits for power generation, canceled or restricted. The $7,500 EV tax credit, gone. Replaced by auto loan interest deductions that favor high-margin internal combustion trucks. Even carbon management has shifted from storage to enhanced oil recovery, using captured carbon to pump more oil. The executive mandate is now drill baby drill. The Energy Department's Loan Programs Office has been rebranded to the Office of Energy Dominance Financing. Its new mandate isn't innovation, it's grid reliability and repowering fossil infrastructure. LNG export bans have been lifted, unleashing American gas onto the global market. But here's where the technical trap lies. Look at the renewable capacity freeze. The OBBBA introduced strict safe harbor rules, making compliance for new wind and solar projects nearly impossible. This regulatory bottleneck is projected to wipe out 110 gigawatts of solar and 210 gigawatts of wind by 2035. It is a policy-induced extinction event for pending projects. Now consider the price paradox. We are producing more gas than ever, yet electricity prices are up 6.7%. Why? Because unleashing LNG exports linked U.S. domestic prices to expensive global markets. Combine that with the demand shock from AI data centers, and you have a situation where energy dominance actually means higher bills for the American consumer. On the social front, we are seeing the engineering of a new investor class via Trump accounts. The government is providing $1,000 per child to be invested in the S&P 500. It's a philosophy of making every American a capitalist, but critics rightly identify it as a backdoor privatization of the social safety net, shifting risk from the state to the market. Industrial policy has mutated into transactional nationalism. Look at Intel. The government converted grants into equity stakes. The state is now a 10% owner. Or look at TSMC. The administration used a threat of a 32% tariff to force a $250 billion investment commitment. This isn't free market capitalism, it's leverage-based coercion. The auto sector has been thrown a lifeline. With EV credits dead and interest deductibility capped at $10,000 a year, the tax code now incentivizes the purchase of expensive, gas-guzzling trucks. It maintains U.S. assembly rules, not to promote green tech, but to squeeze foreign competitors while propping up Detroit's legacy models. Geopolitically, this leaves the U.S. as a fossil island. We are isolated on climate, but aggressive on exports. While the EU builds a green fortress with carbon border taxes, and China expands its green tech monopoly, the U.S. is betting everything on hydrocarbon supremacy. A trade war is not just imminent, it's structural. The final scorecard is clear. The winners are oil majors, Wall Street, and legacy auto. The losers are renewable developers, EV startups, and, inevitably, future generations inheriting the deferred climate risk. The economy is growing, yes, but the costs have simply been pushed into the future. In 2026, America chose to bet against the transition. The great reversal is complete. That's it for today. Turtle out.